So next we're sorting with the investment factor, and we know from prior research, low investing companies typically return more than the high investing companies, and we see that here. And so when we control for this investment, we should also see that smaller companies should outperform larger companies, and that's certainly the case here. But it doesn't really seem to change that much as far as, um, well, the lower investment companies here do, well, there does seem to be a monotonic increase in return as the size of the company goes down. We can see here from the p-value, since it's less than 0.05, we could say these are statistically likely to be monotonic changes, and overall the joint p-value is significant as well. The value factor, when controlled for the investment, doesn't seem to have a monotonic um, change in any of the levels of investment or jointly. Same goes for the profitability side as well. However, we do see it in the momentum side for several of the levels of investment, but this one at the second quintile really hurts the joint MR here. So in sum, what we see here is some of the highest returns come from the high momentum, low investment portfolios, as well as the low investment and very small cap companies. We see that high investment ends up having the lowest returns in most all cases, and if you've got high investment and low momentum, you've got a pretty paltry return here. Okay, so now let's take a look at momentum, where higher momentum companies, those are past winners, typically outperform past losers, low momentum. And so first for the size factor, when we're controlling for momentum returns, it looks like the change in returns for size are only monotonic um, when in the higher quintiles of momentum. So these three here. And the monotonicity of the value factor is only present in the lowest momentum companies. There doesn't seem to be a monotonic relationship for profitability, and the investment factor seems to only be monotonic at the second quintile when controlling for momentum. But so to recap, looks like the highest returning portfolios seem to be the low investment and high momentum, and that's what we found in the prior table. Also high momentum and low profitability. Um, Also value companies that have high momentum. High momentum with small cap companies. But the types of companies that don't return very well would be the growth companies that have very low momentum. Or high investing companies that have low momentum. So next here we have some performance statistics related to the risk-adjusted returns. So before, in all of the tables, we looked at the nominal returns of investing in those strategies, but here they took the most extreme quintiles from the previous tables and looked at the risk-adjusted returns here. So you look at the box of the top BP and the top ME to form that portfolio, the top quintiles, and we would see what is the risk-adjusted return. So we have the Sharpe ratio here, as well as a p-value and standard deviation, the SCAD. And here we've got the long portfolio and the short portfolio, and then we're looking at what's zero cost portfolio here as if you went long and short, and then the p-value here. And so whenever they're making these calculations, they're considering what should be the optimum if things were going to go according to expectations as far as these factors go. For instance, high returning or high BP, which would be value companies, should outperform low BP companies, which would be the growth companies. And then from the ME, small cap companies should outperform large cap companies. So when they're forming these portfolios, they're taking into account what should be the optimum highest returning corner portfolio from the prior tables versus what should be the lowest performing corner portfolio. And so they pretend like they're gone long the expected highest performing and short the expected lowest performing. So the highest would be the high BP, low ME portfolio, and the short would be the low BP and high ME corner portfolio. And the same goes for the other factors where lower investment should outperform higher investment, high momentum should outperform low momentum, low profitability should outperform high profitability. Yep. And interesting, what they do find is that the long portfolio outperformed the short portfolio in all cases except it looks like one, which would be the ROA BP, so profitability and value factor. And several of them, this outperformance comes with a significant p-value in most cases. And we see that some of the highest performing ones tend to be the momentum and value portfolios. And this has been found in prior studies as well, where when you combine momentum stocks with value stocks, they tend to outperform on a risk-adjusted basis. And this is because there becomes a good diversification effect because momentum companies tend to be growth companies. So if you combine momentum with value companies, then you get a big diversification effect. Also here we see that investment and size tends to be a good combination. And so finally the authors look at cross-sectional regression of each of the factors. For instance, if how much of the portfolio's return is explained by these factors. So we have here, for instance, the alpha, a t-statistic for that alpha, and then each of the factors below investment, momentum, as well as their t-statistics. And that way they've kind of normalized in a Fama-MacBeth regression where you might interpret this as, for instance, here with the value factor, a 1% or a 1 standard deviation increase in the BP factor would cause a 1.7% increase in the return to this portfolio. So this gives you a good gauge of the magnitude that each factor employs on the portfolio, and also with the t-statistic we can see if the effect of each of these factors is likely to be non-zero. So first we see with the ME factor in all these portfolios the size. The t-statistic is less than 2, so we could say that none of these are really significant, so maybe the size doesn't play a significant role in explaining the returns of the portfolios. And so the way the authors put these portfolios together, they excluded all of the microcaps, so the smallest of companies, And prior research has shown that the microcaps are the ones that uh, tend to have the most size effect. So excluding those kind of dampens the size effect in these portfolios. And from a value perspective, so the BP, the only one that's statistically significant might be the seventh portfolio here. And the authors explain that this might be because microcaps are excluded as well, because it's found in prior studies that the value effect is more pronounced in very, very small companies. So by excluding those, we don't really have as big of a value effect because the only companies left are the ones that are moderately sized to jumbo. And we see here that the seventh portfolio is the one that has value and momentum. So that's where we found in the prior table that value and momentum had the highest Sharpe ratio. So we see that these factors have the highest statistical significance as well as the biggest effect on the return, where we see one standard deviation increase in momentum causes a 2.4% increase in the return of the portfolio, which actually that looks like it's the highest out of all the factors. And then looking at profitability, all these T statistics are below 2, so profitability seems to not explain the returns of these portfolios at all. Coming down to investment, we see that we've got some very high T statistics here, and all of these factors are actually coefficients are very negative, which falls in line with prior studies that showed that um, the companies that invest the least in assets tend to perform the best. That's why we have negative here. And also very high negative numbers as well, to where maybe a one standard deviation increase in investment causes a 2% decrease in return of the portfolio. And the best combination that we see here is the one where investment is combined with momentum. Um, where if we had a 1% or one standard deviation decrease in investment and a one standard deviation increase in momentum, we might would see a 4% increase in return.